Hi folks, and welcome back to Meaningful Money. Yeah, I'm here high above Gwenver Beach. Not sure if you can get an idea of the sort of size of the drop behind me, but I don't want to lean back, put it that way. The lengths I go to for interesting backdrops, eh? We're carrying on talking about our retirement options, the kinds of things you can arrange your retirement income to look like, the options available to you. We've talked about annuities, 3 different types. We've talked about doing nothing, which is a valid option in itself. We need to just round that up really by talking about income drawdown. So as ever, before we get into it, I must thank my good friends at the bottom right, the 7 Investment Management. I'm very grateful to them for sponsoring Meaningful Money. So income drawdown, that's its colloquial term. It's more correctly called unsecured pension. How does it work? Well, this is very brief, okay? Your fund, instead of handing it over to an insurance company, you keep hold of it, you invest it, and you draw off that fund every month or every year. It's a little bit like going to your own cash machine and drawing off it every month. Now, the government sets the limits of the amount of income you can take each year, and those limits are reviewed every 3 years. It used to be every 5 years. In fact, it used to be every 3 years, and then they changed it to 5 years, and now it's 3 years again. And so those limits are reset every 3 years. Now, that's essentially how it works. You get a lot more to it than that. You can check out episodes 57 and 58. I'll put links up here so you can go straight to those. 57 talks about income drawdown specifically, and 58 talks about phased retirement, an important option. So pros and cons. Now I've got to work out, I've got to scooch because I'm sitting down, which is unusual for me. I'm going to scooch up this way so that I can bring in a bit of a graphic at least. So pros and cons. As with all your retirement options, you get access to your tax-free cash, really important. So you can take 1/4 of your lump sum, 1/4 of your fund as a tax-free lump sum. You get all kinds of flexibility should circumstances change in the future. Unlike an annuity where you set your terms from day one and that's pretty much it, here you've got this range of income you can take. You could turn your income off altogether. You can have more income this year, turn it down next year. Very flexible should circumstances change for whatever reason. And you can choose your level of income. And on death, unlike with an annuity, you have to choose what your death options are at day one. So do you provide for your spouse? Do you have a minimum payment period? With drawdown, it's totally different because you've got this fund, and whoever survives you, say your spouse, has a choice. He or she can either continue taking an income, which will be recalculated based on their own gender and age, or they can take a lump sum, but less a pretty hefty 55% special rate of income tax. So those are the pros, your choice, flexibility, all that sort of thing. What are the cons? Well, the flip side to the coin again, your income level is dependent on your investment performance to a large degree. So every 3 years when those limits are reviewed, your income could go up, could go down, depending on how well markets have done and your investment manager has done. And because the fund remains invested, you have costs to take into account. Okay, nobody runs money for free. The investment managers are in it to make a buck as well. And so there are costs involved and risks, of course. And because of those costs and because of those risks and because of the flexibility of drawdown, you need to build in regular reviews. So it's something you're going to be seeing your advisor at least annually about. And that comes at a cost as well. And finally, there's something called mortality drag, which is a difficult subject to explain in a very short time. But essentially, when you buy an annuity, you benefit from a kind of cross-subsidy, because those who die early and take out an annuity, give up most of their fund, and that kind of helps pay for those that live a very long time. So the sort of cross-subsidy is worked out when you are given your annuity rate. But when you go into drawdown, you're effectively deferring buying an annuity, and so you don't get the benefit of that cross-subsidy. That's called mortality drag, and it's explained much more in episode 57. So who might have a drawdown? I'm going to scooch across again. Like to be central. So who might have a drawdown plan? Well, not exclusively, but it's largely for those who have large funds. Right? Now, there's no sort of prescribed limit anywhere, but as a rule of thumb at Jackson's, we tend to use You need a fund of 100,000 really after you've taken your tax-free cash out, ideally. It's not set in stone, it's just a rule of thumb. And that's simply because the costs and complexity of drawdown means you need a decent sized fund to pay for it really. So those are the first kind of people who might have a drawdown. But again, that's not an exclusive rule or anything. There are reasons in some circumstances why you might have drawdown with funds much smaller than that, but talk to your advisor about it. People who are obviously happy and willing to take some risk, both with the level of their income, which can go up or down, and with the fund itself. You know, if you're going to be doing reviews with your advisor, you're going to see the level of your fund going up and down. That might freak you out, but those who are comfortable with that and understand how it works are the sort of people who might have a drawdown plan. Also, those who are really unhappy about handing over their fund to an annuity company, you know, they want to keep hold of it and keep control. So those are the kinds of people who may have a drawdown. And again, people with other income sources, so they can afford to take some risk with this because maybe they've got a good company pension which is guaranteed or whatever. Those are the kinds of people who might take out a drawdown plan. Now, before I just wrap this up, there's another kind of little sub thing which doesn't really warrant a video of its own, because there is something called guaranteed drawdown, which is sort of exactly as above, everything I've just talked about, except the investment bit has guarantees on it, so they can't go down. There's only a couple of providers offering these things. But those guarantees come at a really hefty price. The increased cost of the investment, you can see it as a kind of insurance premium. So you get the guarantees, which may be worth paying for you, and yet you still get all the benefits and flexibilities, or most of them, of full drawdown. So those are called guaranteed drawdown plans. So your advisor should be talking to you about those as well. Okay, so that's income drawdown in a very quick nutshell. It's a complicated subject, definitely something to talk to a competent advisor about. It's so easy to get wrong, drawdown, so really make sure your advisor knows what they're talking about. Ask them how many they've done, are they specialising in it? We at Jackson's are pensions sort of experts. I perhaps discount myself from that slightly, but our company is built on pensions, so you know, we know what we're talking about. Make sure your advisor does too. Okay, so to wrap up this series, we're going to talk about some case studies. You know, we're going to put some names and faces and sort of personal situations on some made-up people, and look more sort of detail about what kind of options they may go for. And perhaps then you can identify yourself with some of those people, and it might just give you a pointer. So thanks for watching, and goodbye from my precarious position up here on the cliffs above Gwenver Beach. Thanks for watching. I'll see you next time.